Good morning and welcome to Fast Market. It's Monday, November 5th. I'm Tom White, and today I'm joined on set by Scott Bauer, the CEO of Prosper Trading Academy, and Jonathan Honig, managing member of Capitalist Pig Hedge Fund. All right, guys, happy Monday to you. Thanks for being here today. Appreciate it. Some added volatility today in the equity market, Scott. Your takeaway, because it seems like the NASDAQ is once again diverted from the overall market and it's down.
Yeah, it's definitely a bit of a sector rotation today. But, you know, this could change tomorrow. It could change the next day. I'm actually surprised that based on some of the rhetoric we heard over the weekend and coming out of China, that the overall market is not down further, that, you know, the equities are, non-NASDAQ are actually hanging in there.
Right.
Yes, VIX is up a little bit, but I think that has more to do with tomorrow's elections than anything else. But, you know, I think the market's hanging in here overall.
Yeah, he makes a good point there, Jonathan, and we're seeing the NASDAQ down again. The FANG Plus names are down nearly 2.5%, led by losses of over 3% in Apple and Amazon this morning. Your takeaway on this market into a week where we don't have a lot of economic data that's going to move markets early on, but we do have midterm elections tomorrow.
Yeah, I mean, it's Apple and really everything else. Your eyes almost have to be on Apple. I mean, Apple's, what is it, 4% of the S&P 500. It's 12% of the NASDAQ.
Right.
I don't know what it is exactly of the Dow, 6 or 7% of the Dow. So
Yep.
This is a stock that really moves markets. And although I don't trade Apple, I think if you're looking at equities, you have to keep an eye on Apple. If nothing else, it's almost that weather vane of kind of, you know, as Apple goes, so goes the nation. So I'm surprised to see, as Scott said, I mean, I'm surprised to see the Dow doing so well. I mean, McDonald's at a new 52-week high, that's
Right.
helping. There's some other elements helping here, but, you know, for me, I have a kind of a put up and shut up approach to stocks right now, and it's going to be, for me, tough to see markets make a real move forward if Apple keeps, you know, kind of not being able to get a bid.
Yeah, it seems like it's become the barometer for the overall market. And Ryan, if you follow me to the trading platform, I just kind of wanted to bring this up. And we've got a picture of the Dow Jones Industrial Average up there on the Visualize tab under Market Watch. And it gives you a good idea of what's propelling. Now, the Dow Industrials are up 0.5%, Scott, even with its biggest component, Apple, is down nearly 3% at this point. Your takeaway, when you look at, when you visualize it, I think it's easier for investors to kind of get a look at that. But you're seeing strength in other names.
You know, which I think is a good thing, actually, because we're starting to see maybe a little bit of moderation across the board here. Yes, all of the, you know, FANG Plus, like you said, is really getting hit today, but there's some moderation across the board here. And, you know, maybe it's a little bit stock specific
Right.
in this environment, not necessarily sector specific, but stock specific. Nonetheless, though, you know, I think that the market is really hanging in there pretty well with, yeah, we see the VIX elevated today, but not nearly where it was.
Yeah.
I think it is going to get a little bit more volatile before elections tomorrow, and
Yeah.
certainly before the results tomorrow night. But I'm liking what I'm seeing here in the broader market.
Yeah, I mean, I think you're seeing some support and some rotation, Jonathan, out of some names that, you know, maybe they've gone up a little bit too far, too fast. You've seen the Amazons and the Facebooks down today. But you've seen a push into a lot of the Walmarts and Johnson & Johnson and some of the healthcare providers, because prices never go down in there. But
Not for us consumers, at least.
Exactly. But as far as just looking at the overall market, saying, and like Scott said, increased volatility is expected over the next day and a half until we get the results from the election. But looking past the election, what do you see for the overall market?
Well, I mean, it's encouraging to see some healthy rotation. I mean, look what's really doing well today. CVX and oil
right?
stocks, ExxonMobil, which have really been pretty beaten down as of late, and IBM, which has been
Really beaten down lately.
tremendously beaten down. I mean, finally the Red Hat news came out, so it's positive if you're long equities kind of writ large to see some rotation there. I mean, you know, for me, I'm a little probably less bullish on the overall market. I don't see a lot of equities for me making new big bull market trends. Now, maybe it's healthcare. In fact, just the last couple days, I've seen Merck at a new 52-week high.
Right.
That's encouraging here. So, I mean, I think there are opportunities here. For me, I always go back to that line from Wall Street where, you know, Bud Fox goes into Gordon Gekko's office and he says, I look at 100 deals a day, I choose one. There is opportunity out here. Yeah. I'm just being very careful about where I put my assets to work.
I think that you make a great point, Scott. is the fact that, hey, you've got to be a little bit close to the vest at this point, because increased volatility is probably going to happen. It could just kind of get pushed aside. But even if there's a change in Congress as far as the House goes or the Senate goes, typically after those, or historically after those events, the market goes up nearly 100% of the time.
Right.
But now that's historics. I mean, your take on that. I mean, are you going to start looking at, hey, corporate results are good once again, and that's what I got to start looking at, is names that I can get into that have been beaten down.
So as traders, we love patterns, we love historical trends. I would say this year has been anything but, following the trend from everything we've seen in the marketplace this year. Now, what happens after the elections, like you said, even with a change, I think it's in the following 4 months, the S&P average is up about 15% in the following 4 months after the election, where there's been a change here. So it's hard to discount that. But much to your point and much to what we talked about earlier, I think it is really going to be more stock specific, not necessarily sector specific.
Yep, I agree with you there. But some of the data I wanted to give you on the S&P 500, about 75% of the names have reported profitability growth or growth on those companies reporting. They beat in EPS, about 77% of those names have, a little bit lighter on revenue. But we're up at near that 25% growth level for these corporations year over year on a quarterly basis. This will be the third quarter in a row that we've had sustained plus 24% growth as far as the S&P 500 goes. What does that mean for equities going forward? Have we topped out?
Well, what's so funny is, I think oftentimes people look down on traders because they say, oh, he or she is just a trader. What do they know? I'm an economist. I'm an analyst. But that's what we trade. We trade price.
Yeah.
So, I tend to be much more on the price side. And, the fact that stocks and companies are beating their expectations, yet the market is weak, for me, writ large, that's kind of a worrisome sign. I mean, ideally, as the old saying goes, markets climb a wall of worry.
Right.
So I'm a little worried as someone who, I'm not long a lot of stocks, but as someone who's looking at stocks, I'm a little worried about good news and weak price action. As if I was long the market, I'd much rather see bad news and strong price action.
Yeah.
So this to me, and the fact is, I said, I'm not a Cassandra, I'm not a big bear, but the fact that consumer optimism, consumer confidence is so high.
Yeah, near record highs.
This is record high. So, there's a lot of enthusiasm about the economy. That's great, but that also tends to happen at bull market tops rather than at bottoms.
Yeah, he makes a good point there, Scott, because price action has been pretty weak, even with those solid corporate results on that side. But, do you look at individual names or do you look at sectors? And do you tell your traders with your group, do you say, hey, stay risk defined, stay close to the vest in times like this where you think there's going to be maybe added volatility?
Well, we're always risk defined, whether it's, whether the VIX is 10 or 11 or whether the VIX is 20 plus, we are always risk defined. But that being said, when you get in periods like this with VIX plus 20, it certainly makes the sell side of premium, when you're talking about options, a little bit more attractive because you're getting, more premium. The added volatility is more premium. But yes, to your point, Tom, you do have to be close to the vest because we are just a headline, a tweet, some geopolitical event away from the market moving 3% one way or the other.
Yep, and VIX maybe at 30 or VIX maybe back down to 15, 16.
Exactly.
I think we're going to probably have a base around there in the VIX. But Jonathan, I wanted to kind of turn to Treasury market a little bit. We've got the 10-year yields down minimally. We've got the 30 and 10-year Treasuries up a little bit because there's a little bit of risk off. Yeah.
When people are scared now, they go to VIX and they go to Treasuries. Treasuries are a fear trade, despite the fact, I guess by a lot of technical measures, they're really in a bear market. Since the last time I was here, there's seemingly a lot more bearishness about Treasuries.
Right.
I'll just kind of speak my own book. I'm more impressed or maybe distressed about the weakness in a lot of corporate bonds. Like I'm looking at trades like, let's just say a lot of corporate-oriented ETFs that are really doing quite poorly right now. So despite the fact there's a lot of talk about higher interest rates, my focus is actually on interest rates for a lot of corporate bonds. So I'm a little mixed. I'm not as bearish on Treasuries as I once were, but that's really only because I think if in a big stock sell-off, you're going to see Treasuries get bought.
Right, and we had the 10-year yield, Scott, up near 7-year highs just last week, above 3.2%. But we've got more supply than I think since 2006 coming on board this week between bill auctions early in the week, and then we've got a 3, 10, and a 30-year auction over the next 3 days. Do you look at that as saying, okay, these guys that have been short Treasury market and long rates, that's going to continue because there's so much supply because we have to pay for the things that we've done as far as the administration goes?
Exactly. That's a great point. But the wild card here is what happens tomorrow with the elections. And I think that has, can tip Treasuries, the 10-year here, back to well above 320 or, back down to 315 in a matter of, less than 24 hours, quite frankly.
I have to say, I just think strangely, Treasuries and bonds are a much more, for me at least, interesting market. A lot of our viewers, I know, talk about stocks, and there's a lot to talk about stocks, but given the panoply of different options right now in terms of different ETFs and funds and ways to play the Treasury market, everything from, interest rate market, everything from junk to corporate to high yield, there's interesting things developing there, and I think opportunities to make money, long and short.
Yeah, and for the individual investor, that's become a better way for them to get in and out of different sectors, especially the Treasury market, because there's so many products you can trade now. Yep. But I kind of wanted to hit on the fact that, the overall market during October was down. But at the same time, Treasuries weren't. Treasuries were down also, and we saw rising rates, especially over the last week. Scott, your takeaway from that is that a canary in the coal mine type of situation where you say, hey, you know what? The Treasury market doesn't care right now what the equity market's doing. It's continuing to fall, and rates are still rising.
So I think that's another byproduct of what I said earlier this year, that this year has been anything but the norm in trading. And I think investors, the retail people that are out there are still looking to really find their footing. You would have said with all the geopolitical risk, all the event risk that we had this year, that gold probably wouldn't have performed as poorly as it did.
Right.
Yet it did. So, I think we're in this period of time that the general public and the retail trading world is really still trying to find, okay, what is the real hedge, or where's that next move coming from?
Right. Yeah. I think we have to take a look at that, and Scott makes a good point as far as the retail investor, because he can't make heads or tails of this market over the last month and a half or something or so, and then we've got the midterm election, so there's going to be some added volatility. Why can Apple report good earnings, but then the stock falls 8% or 9% from earnings? That's what we got to look at. And I think that's what the investor and our viewers are trying to figure out here at this point, Jonathan.
Well, it's the market is like a watercolor painting. It's never really dries. It always is changing. And you benefit, I think at least, by taking your time. I think oftentimes people think investing is almost like you bury a time capsule. Mm-hmm. You make all your trades, and then 6 months later you come back and you see. So every day we're learning a little bit more information about exactly what's going on. And new trends are absolutely emerging. Even if nothing else, and this isn't a long or short call, but seeing the weakness in the FANG stocks. We talked about October. Amazon down 25-something%. These Tesla's been up, but Tesla getting kicked as of late. So there's new trends emerging. The frustrating thing is, I think, as an investor, is that there's no news oftentimes to accompany the trends, because the trend leads the news. Right. So by the time they're talking about whether it's a jump in interest rates or a jump in the Baltic Dry Index, the move has already been made, and that's why I think price is the best indicator.
Yeah, price has been leading lately and kind of pushing back against economic data. But Scott, we've got a lot coming out this week as far as economic data goes. We've got some earnings names coming out also. Not a lot of big stuff because, like I said, 75% of the S&P 500 is already reported. What are you looking at as far as economic data goes this week that might pique your interest, or as a trader or as an investor?
The big guys are behind us, but we have PMI. I think we have ISM manufacturing. So those are two to really look at. Coming off of the jobs report and wages that came out on Friday, it's almost a letdown this week, quite frankly. And again, I think that the numbers that come out this week are greatly going to be overshadowed by A, the elections, and B, some Fed speak that comes out.
Yep, we've got an FOMC meeting this week, Jonathan. As far as those yields and rates go, nothing's expected as far as a hike from the Fed, but we're probably going to get a statement from them. There's no press conference at this one. The two-day meeting ends on Thursday. What do you expect out of those as far as a trader can look at and say, hey, are they going to get more hawkish? Because they've been plenty hawkish lately, or are they going to be a little bit more passive and pull back a little bit?
It's so frustrating. I mean, oftentimes as traders we overthink. I overthink moves, right. And you want to be. Going back to reminiscent of the stock operator here, you want to be long in a bull market and short in a bear market. There's a lot of reasons you could say, well, treasuries could probably rally here. One of which is being everyone's talking about higher rates.
Right.
But I just look at broad market trends here, and I see corporate bonds weak, I see high yield weak, I see treasuries weak, as you see writ large, maybe not this last couple of days. Right. So, my instinct is to want to really be short bonds across the board. And it's funny, Jamie Dimon, we don't talk politics, but a couple of months ago, Jamie Dimon talked about treasury yield at 5%. He didn't get a lot of attention for that. That kind of seemed like, what is he talking about? But that could happen.
But we did see a lot of rhetoric out of some of the pundits last week that were saying, hey, Fed's got to pull back on their hawkish commentary, get off the neck of the equity market, and just let it go and just be more data dependent instead of coming out with these hawkish statements. Scott, your take on that?
The Fed's going to do what the Fed's going to do.
Yes,
they're not watching headlines. They're not listening to to people bashing them about what they're doing.
And what can we do anyway? It's not like it's like a fact of nature. It's out of our control.
Absolutely. But that being said, though, outside of that wage number and the continued strength in the job market that we saw Friday, I've actually thought that the numbers have been a little bit weaker over the last few months, or over the last month or so, which to me says maybe that is what makes the Fed just come back, bring in the reins a little bit. But then you get that big number on Friday, and now it's back to, okay, we don't want to overheat again. So, the Fed is acting in and of itself.
Right.
They're not listening to anyone. They're going to do what they feel is best for the overall economy. And in my opinion, they've done a pretty good job.
Yeah, they have. And you know what? And everybody's been telling them to raise rates. They've been too pushed back, and they haven't been real strong about their hawkishness. They've been, I think Yellen maybe was a little bit more passive in her statements.
A little bit.
Yeah, just a little bit. But you're starting to see that now that they're actually raising rates, people are starting to freak out a little bit. But that being said, as far as you said, with the potential for them to continue to hike, it seems like as far as inflationary numbers, and we've got a PPI on Friday, so we'll start seeing some of that towards the end of the week as far as inflation data goes. It seems like, just like Scott said, unemployment is low. Wages are finally starting to increase a little bit, but that's the only thing that's starting to become inflationary. Does that give them the right to say, hey, we're raising in December and we're hiking 3 or 4 more times in 2019?
I've long since given up trying to decipher what the Fed is going to do, what they should do. I mean, they're going to do what they do. What I worry about is a very common practice of buying securities for yield, buying securities for income. And this is what many of our viewers do, I know, whether it's master limited partnerships or treasuries or high yield bonds or anything else. And it's always relative. So my fear is that when you might buy a bond yielding 3.5% or 4%, in this environment, it looks pretty good. But if yields go up across the board, it starts to look much. And I think there's just, I don't know, we haven't really seen rates crack like we've seen every other market crack. So I have to trust the trend, and I would be very I'd be very fearful to buy anything with any long-dated paper right now. I know it's cliche to say it, but I just see whether it's preferred stocks or master limited partnerships, anything that pays a dividend is breaking up right now.
Yeah, and a lot of the supply that comes on board this week is a lot of short-term stuff. So that's where short-term loaded. But guys, I wanted to kind of get to a name that's kind of in the news a little bit. We've got Apple, and I wanted to take a look at that. Stock's down nearly 7%, Scott. It was under $200, traded down to $198.17 earlier today. As a trader, as an investor, and what we're trying to do on this show is show people how to take advantage of moves in individual names. We've got Apple down significantly today. When you talk to your clients, when you talk to other traders, what do you go at when you look at something like Apple that after earnings, like I said, is down over 9%?
So if you pull up the chart here, you'll actually see that 197.5 area, there, right down there, which we almost hit today, there's a gap there. There's a gap from the earnings back in August.
Right.
We were targeting that this morning, my clients and myself. We were targeting that this morning, that if we got to that point with the elevated vol today, we're going to sell a put spread into that.
Okay.
Because that's one of those indicators, that's one of those gap indicators, especially on a volatile trend like that, that happens to be a really good indicator. Now, you can say, well, Scott, there's not much there, but if you go down just below around the 192 or so, I believe that's where the 200-day moving average is.
Okay.
So there is some support down below that, but on a shorter term trade in a shorter term, talking this week, I would actually only do a weekly with that. That 197.5 level is really, really indicative for me. Longer term, if I were going to put something on an Apple a little bit longer term, I'd wait to see if it comes down to the 192 area of that 200-day moving average. And if it did, that's probably where I'd start nibbling.
Okay. He makes a good point here, Jonathan. As stocks move, and this is post earnings, so you still have, you have that event risk gone from this particular name. And then you look at this name and you say, hey, they had a pretty good report. They're going to be a little less transparent moving forward. And that was showing some concerns with some of the analysts. But they still did really well. They still have a big, solid balance sheet of cash, $230 billion or so.
Yeah.
So do the dividend hikes and the buybacks start coming in, where you need to look at what Scott talked about? And follow me here to the trading platform, guys. I kind of want to hit on what strategy Scott was looking at. Now, how far do you go out when you're looking at short put verticals on this, Scott?
So this week, this is very short term. I'm looking this week.
So the 9th, okay.
The 9th. But what's great about the 9th is, it's not necessarily a day trade. Because this is Monday, we have all week. There's going to continue to be some volatility in the marketplace. If you look at the implied volatility this week, it's substantially higher than the following weeks just because we're just coming off earnings and because of the downward move today. So I'm really looking at this week's put vertical for a sale. And like we talked about early, it's still risk defined. I'm always going to be risk defined here.
Yeah, especially with this name, because a lot of people got hurt in earnings on this particular name, Jonathan. But now, Scott, we always talk about probabilities of finishing out of the money, and that's what we've got right here on this column. We want those probabilities in our favor. Scott's selling a put spread, Jonathan, so it takes advantage of time decay, where we get paid to hold that position, and we've got that bump down to a strike that's out of the money to the downside. So we give ourselves that probability of success.
So much going on here. I mean, Apple, just the importance of the stock, if nothing else, is an indicator. I mean, Scott has a really innovative, interesting approach. I mean, I'm not a dip buyer. I don't play for bounces. But these types of strategies, I think, emphasize the fact that there's a ton of ways to make money in the market, especially at a time now people are looking for kind of, quote, income ways. They would never think of selling puts as a means of income enhancement to their portfolios. So, I mean, I would, for me, I'm avoiding Apple. It's just not a name that's interesting to me. I mean, we all have our own style, but thinking, and more than anything, what Scott said about risk definement, because everything is risky. There's risk in walking down the street, and any stock you buy has risk, no matter how, quote, safe it is. But by taking some means to limit your risk, whether it's in selling a spread or stop loss orders or whatnot, I think that's how really, what separates the profitable traders from the unprofitable traders long term.
Yeah, he makes good points there, Scott, but go ahead and walk me through what type of probabilities do you want? What type of areas do you look for when you're selling that put vertical?
Typically, I'd look for somewhere between 65 and 75% probability here. So
maybe the 195?
That's exactly what I was targeting, Tom.
Okay, now how wide do you want to make this? Do you want to make it $2.50? Do you want to make it $5?
I'm making it $2.50.
Okay.
I'm going to keep it a little bit closer to the vest. Now, I'm not looking for this to trigger until we trade probably back down to the 198 area or so. So, I'm not going to offer it right here. I'm going to offer it above like what you're doing right here because, I don't necessarily want to sell it right here, but if it gets back down to 198, I'm going to sell it and collect probably an extra 20 to 25 cents of credit. So somewhere in the 80 to 85 cent range is where I'm going to put this out. And I like that a lot because, again, it's totally short term. It's this week.
4 days to expiration.
4 days. My break even on this.
What is the bid offer now? You're offering at 80?
It's 60
right now. It's
cents
60 cents.
The midpoint
60 bid?
Yeah, it's 60-60. I mean, Apple is a great market. So I'm offering it at 80, which if the stock moves down another $2 is not out of the realm of possibility. Okay, so at that point, if we were to get filled on this example trade here, with 195 being the short strike and 80 cent credit, I'm at 194.20 for this week as my break even. I don't care what happens after this week. It's this week. I love that.
And you can see right here from the Analyze tab, Jonathan, that we've got, and this is a great lesson for all of our viewers too. You get that probability. I've set the break-even point to what Scott said, 194.20 down here. So we've got probability of success because Apple's currently trading over 200. But look at our probabilities of that break-even being out of the money, about 80% nearly probability. And that's what we talk about, one of those silos that we always try to hit on. Is that we want to collect time decay. We want to take a neutral to bullish stance, but the probabilities are in our favor, and also we're collecting time decay, and most importantly, our downside is limited to what the width of the strikes are minus the credit that we collected, which is risk-defying.
When I first discovered and learned about selling puts as a young trader, it dazzled me. It mystified me. I never really developed the skills, I think, as so many of you others have, but it's a tremendous strategy. More than anything, as you said, when you can define your risk and take advantage, some of the tools that are offered, whether it's the probabilities or the estimating of volatility, are so tremendous.
Visualizing it on the Analyze tab is, I think, the most important thing.
This is a huge opportunity, I think, for traders or nothing else to learn about ways to make money no matter what the market does. Yeah. And we always say for the long term, but you guys are outlining strategies that can make money in a week or less. This is a value.
Yep. So we're going to go ahead and send that in about 4 times, Scott. We'll take a look at that. We'll manage your trade until completion.
Now, does Scott get a cut of that real money?
No, this is just an example trade.
Right.
And a way to take advantage of a move in Apple. All right, guys. I'm going to have you guys back towards the end of the show, but coming up next, it's Face Off, fundamentals versus technicals. We're going to look at CVS ahead of earnings. Stay right here on the TD Ameritrade Network. Fast Market will be right back. Welcome back to Fast Market. I'm Tom White, again joined by the CEO of Prosper Trading Academy, Scott Bauer, and Jonathan Honig, managing member of Capitalist Pig Hedge Fund. All right, guys, just a quick market check. It seems like stocks have kind of stabilized around the flat line as far as the S&P 500 goes, but we're still seeing weakness in the NASDAQ and the Russell 2000. Scott, your take on that?
Again, I think it's some positioning ahead of the elections, a little bit of a sector rotation right there. Overall, though, market really hanging in there. VIX off of its highs. It's up a little bit, but as well it should be with what we have going on this week.
Yeah, we're starting to see some weakness in information technology, and that's mostly the FANG names, the FANG Plus names, NVIDIA's, some of the other ones, Facebook, Apple. But we're starting to see a big move into financials today, Jonathan. Consumer discretionary is pretty strong, and healthcare once again strong, kind of leading the Dow Industrials and the S&P 500.
The rotation is positive, I think, in general, because it kind of indicates that there's really no systemic fear that's causing all stocks to fall. I mean, I'm surprised, I should say. I'm encouraged to see some rotation into financials. I mean, Citigroup was at a 52-week low not too long ago.
Yeah, just last week.
Yeah, so I mean, these have been kind of weak stocks despite the promise of higher rates. Right. But when you look at, Google down 3%, Facebook down 1.5%, Amazon down almost 4%. Again, I'm kind of a mind that says as FANG goes, so goes not the nation, but the market, because these are just such dominant parts of the overall market. It's not, for me, it's not unlike the late 1990s when essentially Cisco, Oracle, Sun Microsystems just became the dominant parts of all the indices. So as they went, so went the indices. I think we're in a similar situation.
It makes a good point there, Scott, but we traded down the floor back then in the late 90s, early 2000s, where you came down and your valuations were out of whack, and you had the tech bubble that started in 2000. But right now, valuations aren't too bad on a lot of these companies.
No, it's a completely different era, completely different macro environment right now, and this is the ebb and flow of the marketplace right now. And I think to try and dissect too much of what's going on, given all of the headline risk, not stock-specific risk, but given all the headline risk, I don't know that you could take too much out of it.
Yeah. Well, I'll have to wait and see on that, see if the NASDAQ can recover some of those losses into the close today. But we do have some earnings coming up, guys, and CVS is one of those names. We just discussed this during our face-off segment with Ben Watson here, and Walgreens Boots Alliance, one of their competitors, has been doing pretty well. CVS up $1.40 today, up nearly 2% ahead of this report. That's pretty surprising going into this. It yields about 2.7%, Scott, so it might be used as a safety play as the FANG's rotational stock going into these earnings. But we've actually got puts out trading calls nearly 2-to-1. But IV percentile rank, if you look on the trading platform here, guys, IV percentile ranks elevated at 84%. Going into this report, which we historically see going into an earnings event like this. Anticipated market.
What does that mean when you say it's 84%? 84% higher than normal volatility?
It's 84% is based on a 52-week wide window. It's at the 84th percentile for those 52 weeks. So up at the upper end.
Of it's as volatile as it's been.
Yeah, it's the upper 20%, upper 15% of where it's been over the last 52 weeks.
So anytime we look at numbers like this, and Jonathan, this is a great question for our viewers too. Anytime we look at that current IV percentile rank, if it's above 50%, it's elevated volatility based on a 52-week range. And that's what you have to remember when you're looking at that number. That's 84% is based on a 52-week cycle of the high of 39% on an aggregate basis, a low of 21. We're currently at 36.73. So you can see there we're up at the elevated range for that 52 weeks. And you can also look here on the chart. I put up an implied volatility lower down here, and you can see that the implied volatility is relatively elevated compared to the previous 52 weeks on this particular name. So that's a great lesson for our viewers. Why do we look for elevated volatility? Well, if we want to do strategies to take advantage of time decay and higher volatility, that gives us a good guide for that particular name. But anticipated market maker move, Scott's about $3.40 on this particular name, so it's pretty elevated for a CVS or a WBA, which is Walgreens Boots Alliance. What do you look for in this particular name? And I'm going to put you on the spot here once again with CVS. What do you look for trading this? Because we have an aggregate volatility of 60% in the near term, and then it goes down to 47% and 40%, so it decreases quickly.
So number one, I think it's trying to catch up to WBA, or the market is trying to get CVS to catch up to where WBA has been over the last couple months and the momentum behind it. I love this stock. There's a lot, in this space right now. There's a lot shaking out with their merger with Aetna. To me, there's a lot of upside potential. Now, that being said, I don't want to get stuck buying excess premium going into this print because, like we just said, the volatility is going to get whacked. The premium is going to come out. So how do you potentially take advantage of an upside move and not get long premium?
Right.
Well, I'm sitting in Kevin Hink's chair here. So, if he were here, I know that he would want to probably sell an unbalanced put butterfly.
You buy a put.
Buy an unbalanced.
For a credit.
For a credit,
yeah.
Right. I say sell so he can get a credit. I'm not of that mindset.
Right.
So I would actually look for something that is volatility neutral, vega neutral to the upside. More of like maybe what I call a broken wing butterfly spread.
Okay.
So an upside call butterfly. Okay. But instead of the normal butterfly where you have an equidistant or symmetrical amount between your long and your shorts, you actually skew it to get long deltas.
Yeah.
But you're volatility neutral. So even when volatility gets annihilated here, that doesn't cost you.
Okay, well give me some strikes here, and I'm going to show that, because this is a good lesson for our viewers, and Jonathan, for us to go through these steps to create these type of positions that take advantage of that higher elevated volatility. Go ahead.
So you had said that the expected market maker moves about 340 or so. So that gives me on the upside a target of about 78.
Okay.
Okay, so that's going to be my center price.
Okay.
So what I'm looking to do then is buy the 75.
Okay.
Sell the 78.
There we go.
Sell two
right
of
there.
those.
Sell two of the 78.
Two of the 78.
Okay.
And then instead of making this a normal butterfly, which would be 75, 78, 81, so it's $3
If it was
on each
equidistant,
side,
correct.
I'm going to skew this, and I am going to buy a 79 call.
Okay, so you're going to skew it up Are you going to skew it only one strike?
One strike. Okay. So I have a long $3 wide call spread and a short $1 wide call spread.
Okay.
Okay. So it does cost me money.
It's going to cost you about 88 cents.
Cost me 88
cents. Okay.
But what it does is it removes the volatility risk. It removes the vega risk because, as you can see here, the vega risk is pretty neutral.
Right.
Okay. And it skews my deltas to the upside.
It does skew your deltas to the upside. You make a good point there, because by not selling that vertical, the 78.81, you're selling the 78.79. It shortens up the width of that, and that's why you probably pay a little less debit. But if you can see right here, your upside, if it does go up higher, the only risk you have is that downside below about 75.90, what you paid for it, plus the 75 strike that you bought.
Right. So the upside here, I'm basically a winner all the way on the upside. Where in a typical butterfly, if it goes up towards that last strike or beyond, then it doesn't work out that way.
Yep, we're going to go ahead and put this in, because this is a new strategy, because typically we do those unbalanced put butterflies and we'll take advantage of time decay. But this one takes advantage of a strict move. Now, you can do this on the call side or the put side based on what your assumption is.
Correct.
And Scott's just giving you this example of a bullish type trade here, Jonathan. Now, you need this stock to go up for this particular trade, but it's still risk defined. Is that the key to this trade?
Yeah, well, I think it's the key to any trade. When people hear about options, especially selling options, what is their first response oftentimes is, that's so risky, I couldn't do that, I'm much more conservative. But what Scott's outlining here is a very specific approach to a stock, to CVS, that can make money on the upside and limit your risk on the downside.
Right.
That's what's tremendously important here. And I have to say that the news about Amazon getting into this business is really out now. That was kind of last year's story now.
Right.
So maybe this is an opportunity. It's only $15-20 off the 52-week high.
Yep.
This is an opportunity to make some money.
Well, I put that in 2 times, so we'll go ahead and, Scott, I'm going to give you credit for that, but we'll manage it for you, okay? Because that's a key part to these example trades that we're doing, is showing people how to manage them.
Yes, how you follow up.
All right. And there is one thing I wanted to hit on, because we've only got like a minute left, guys. We do have some positions on that I kind of wanted to hit on, and we're going to go to activities and positions here. We've got a Tesla position on.
It's like a short call.
Yeah, short call spread. That one's working out well. But I also wanted to hit on something that we did as far as a a strategy to take advantage of a pullback, and that was Yum, Scott. We did one of yours and my favorites.
We did.
We bought a long call calendar in there, December, and we sold the November 87.5 puts. The stock spiked after earnings, but I'm going to create a closing order because we only paid 63 cents for that. Is it a good time to close that, or do you roll these, Scott? Because it's right by 87.5 on that.
So, question is, did you do this specific for the earnings, or did you do it for a longer-term play? We did this right for earnings.
Yeah.
Okay. And we have 2.5x our investment right now. I'm out.
You're out, and that's a great trade management skill. It's like, hey, I did it for a longer term, but it's working out well immediately. Let's take advantage of this because the stock's right by our strike, Jonathan. And that's what we try to teach. All right, guys, thanks so much for being here. Scott Bauer and Jonathan Honig, very much. Tune in tomorrow at 10 a.m. Central Time right here on the TD Ameritrade Network. Have a great day, everybody.